Good afternoon, good morning, or good evening, depending where you're joining us from today. My name is Brett Evans, and I'm the Managing Director of Atlas Wealth Management. Joining with me today is my colleague, Ben Turner, who's the Managing Director for Atlas Tax. Just want to get a quick consensus out there. Can everyone see the screen? And if you so desire, see our ugly mugs on the screen? Just put it in the comments or the questions field there. That'd be fantastic, just so we make sure we know who we're talking to. Yep, fantastic. Thanks, Andrew. Thank you, Liz. Okay, fantastic. Rightio, we're just waiting for a few more folks to pile in now. We've actually got over 400 registered for today's webinar, which is great. Certainly very topical with the residency rule changes, and thanks to Ben for jumping on this one with me, because Ben runs our tax division, so the residency rule changes are very close to his heart. But also too, I will say he's got a newborn, so and it's also the end of the lodgement season for tax returns. So be gentle to Ben. Don't mistreat him. Don't abuse him. He's a good man and comes from a good place. So also too, while we're just waiting for the last stragglers to come in right now, if you do have questions as we're talking, please just put your questions in the questions box. At the end, we'll have a bit of Q&A. What we're going to do is probably talk about 30-40 minutes on the topics that we'll run through very shortly, and then throw it over to Q&A, and Ben and I are all yours at the end of the day. Rightio, folks, well, let's get this show on the road. So no conversation with any licensed professional will be complete without the usual disclaimers. Essentially what this document here means is that all the information should be treated as general nature and should not be treated as personal advice. We're dual regulated, both in Australia and here in Dubai. So that's our Australian disclaimer out of the way. And then I'm based in Dubai here in the DIFC. And this is my Dubai disclaimer, essentially saying the exact same thing. All the information is for educational purposes only. And if you do need to get personal advice, please reach out to us and schedule a time, which I'll include at the end. So who is Atlas Wealth Group? Essentially, we're the leading provider of financial services to the Australian expat community. Where we're different from a lot of other folks is we don't sell product. All we do is provide advice. So we don't sell property, we don't sell any of that sort of stuff. We're the leading provider of tax, financial planning, and mortgage services to expats in over 50 countries, regulated by ASIC, the ATO, and the DFSA. What does that mean for you guys? We're under audit 9 months of the year, so we keep our pencils nice and sharp and make sure the advice we're providing to you is always compliant. All of our advisors and directors are degree qualified, so we weren't selling used cars 5 minutes before we jumped on this call. I haven't actually counted the years between Ben, James, and myself in terms of years in the industry, but probably don't want to know. You can probably tell by the beard how many years there are there, but yeah, we've got enough years to know that we've got a bit of skin in the game and we know what we're talking about. On the agenda today, essentially we're going to run through some key points, and we just really want you guys to walk away from today's call with a bit of information to help you make informed decisions. So Ben will be running through the upcoming Australian tax residency rule changes. I'll then be talking about the changes to the UAE and the service benefits. For those on the call who aren't based in the UAE, it's probably a good time to grab a coffee. Then I'll be talking through property, share, and currency market updates. Obviously, what's going on in Israel right now will certainly factor into that conversation. And then last of all, Ben and I will talk about some just quick strategies you can employ on your finances that will give you hopefully a positive benefit that you can take away from today. So, mate, let's get the show on the road with you, and I'll hand the virtual microphone over to Ben to continue the conversation on the tax residency rule changes.
Thanks, Brett. Appreciate that. So, I think there's not a day that goes by that someone doesn't talk to me about these new rule changes. Now, one thing I want to be absolutely clear on is that these are proposed rules. I don't want anyone to think that these are what the legislation will look like. We're a long way from that process yet. We started out with a report back in, was it 2016, I think, where they looked to change the rules. Everyone acknowledged that the current rules needed some work. As mentioned in that slide there, the old rules were written way back in the 1936 Act. And whilst the principles are pretty well established now, there's a lot of ambiguity on a day-to-day basis that we see. So just want you to bear in mind that what we're talking about here is a potential proposal, and what we're actually going to see in actual event is probably going to change significantly. So whilst it's important to understand what they're outlining, we also need to be aware that at the moment, the state of play is 100% the way it's always been. And my view is it's probably going to be so for the next 18 months or so, as well as there may be a grandfathering provision as well, which was part of the submission documentation that was put forward, that they don't want people to really be caught with their pants down, so to speak, with plans that they'd made, and all of a sudden the rules change and it upends their whole position. So just need to be aware that that is likely to be part of the new proposal as well. So it's probably important to understand, I guess, what residency rules are, and a lot of you will probably have some familiarity with this, but there's 4 tests for you to be an Australian resident, and you're going to need to satisfy one of those to be an Australian resident. They are the resides test, the domicile test, the 183-day test, and the Commonwealth superannuation test. Now, the simplest is probably the Commonwealth superannuation test, which applies to people who are on effectively diplomatic postings, where they are part of a government-based super program that they're contributing to. If you're not contributing to it, so if you're ex-military service and not contributing anymore, then that wouldn't apply to you. But it's designed to catch those people who are on those postings, who are still, for all intents and purposes, earning their income from Australia. The 183-day test is a test that's focused mainly on people coming into Australia. A lot of people do think, I'm not here for 183 days, so therefore I'm not an Australian tax resident. That is not the be-all and end-all. There is also 2 different parts of that test as well. So you don't satisfy that test if you have a usual place of abode outside of Australia. So typically long-term expats who are thinking that they're going to be outside of Australia for a while, they will not pass the second part, which means that even if they are, for whatever reason, within Australia for 183 days a year, they won't meet that test. The resides and domicile tests are the most applicable tests for expats. Resides test looks at common principles. Where are you living? And it's a bit of a pub test sort of feel. There's a lot of factors that the ATO have looked at over the time, and courts have looked at, but they look at, where's your family based? What have you done to cease those ties with Australia and create those ties in that new country? Have you rented out your house, or is it still available to you? Have you sold it? Have you given up your lease? Have you taken up a lease in a new location? Have you moved your belongings with you? Have you sold belongings to come across? Do you still have a car, pets, those sorts of things based in Australia? And where are you spending your time? Are you back and forth with Australia a fair bit? Do you still have one foot in Australia, or have you actually made a clean break and come back to Australia maybe for the odd wedding or to see family once a year? In that case, it's probably that you have established that life outside of Australia. And as part of the domicile test, the default position is, if you're an Australian citizen, you would become an Australian tax resident unless you had that permanent home established overseas, permanent being at least 2 years. But those other factors that I talked about from the resides test are also relevant in considering whether or not that permanency is established. So that's the sort of lay of the land with the current rules. There's a lot of grey, and there's no, and really when there is uncertainty, we sort of rely on, I guess, a number of checklists that the case law principles have established to be able to try and put someone in a bucket one way or the other. But the only way to get absolute certainty is to apply for a ruling from the ATO, which often does favour the tax office if they see you're going to somewhere like Saudi or UAE, which is a non-taxing jurisdiction locally. Then they're probably more inclined to decide to want to treat you as a resident versus non-resident. So it's something we are really looking forward to having some more clarity, where we can say, yes, you fit this particular criteria, you are a resident or non-resident. And that's really what the rules are looking to do. Although in doing the particular plan that they've drawn up, in my mind, it's more complicated than the current process, albeit it's probably easier to determine your residency with certainty. The proposed changes are, they start off with a 183-day test, which is the first bright line, looking at where you're physically located. And if you are in Australia for 183 days for that year, then you're a resident and then you can stop there. So that's actually a lot stricter than the current rules, because that wouldn't be the be all and end all in the current tests. The government officials test is the same sort of applicable test, which is the other test, which is a you're in or you're out, and that's effectively to mirror the Commonwealth superannuation test, although they realise there's other government officials that don't have Commonwealth super, so they've broadened that in that respect. But if you don't meet the 183-day test, then you look at other objective rules tests that they've applied. What they're trying to do as part of the establishment of these rules is trying to eliminate where people become residents of nowhere. So there is this emphasis on keeping you a resident as long as possible, so that you don't have this issue of being a resident of nowhere and potentially having this, no tax in any jurisdiction. So I can understand the rationale for that, but in my mind, I think it results in something that's pretty heavy-handed in the stickiness of some of these particular rules.
Sorry, mate.
Just skip to the next one.
Yep.
So with the sub-tests, they look at a number of lifestyle-based factors as to whether or not you've ceased your residency. And the current proposal was that you would only need to satisfy 2 of these tests, along with spending 45 days in Australia, and you would then you'll be treated as an Australian tax resident. And they are a right to reside in Australia, in which would be applicable to most people who are a citizen. You have Australian accommodation, you have Australian family, or Australian economic connections. And I believe the next slide sort of delve into these a little bit deeper. So right to reside in Australia is, if you've got a right to reside permanently. So if you are a permanent citizen, a citizen or a permanent resident, then you've already met that criteria. So you've effectively only got one more to play with under the current proposal. But what we put in our submission was that wasn't enough, and we thought, and I'm optimistic that there'll be enough people that have submitted to Treasury that this test is probably a bit heavy-handed, but we'll wait and see what comes from it. Australian accommodation is, if the individual has accommodation available to them at any time during the year. Now, normally that is when you've got a legal right, so like a lease or you own a house that's sort of kept vacant. This wouldn't be the situation in my mind if you were living with parents, went overseas, and you could come back because you've always had your bedroom there in Australia. But if you did have a house and you rented it out, then you, on the flip side, wouldn't be treated as having met this condition. Australian family is looking at where your immediate family is located. So we're not talking about the broader family, but we're talking about spouses, children under 18, so dependent family effectively. Economic connections is something that I've got a little bit of a problem with, because they seem to be satisfied really easily. So obviously Australian employment, I think, is quite reasonable, or carrying on a business in Australia, or having interest in certain assets. But certain assets that they say, such as taxable Australian property, well, obviously everybody's main residence would be taxable Australian property. So that, to me, raises some alarms. A bank account with significant cash deposits, well, they haven't really outlined what that would mean. How much is a significant cash deposit? Does that include money sitting in an offset account, for example? An interest in a family trust, well, again, that might not necessarily be in an individual's control if they are part of a broader family trust group. And so in my mind, I think this test here needs some real work to consider that, because it might keep you in the residency remit, even though in my mind, they're not strong factors to say that you haven't left and picked up your life and moved it overseas permanently, which is the current rules effectively.
Yeah, it's an interesting, Ben, too. I was talking to someone the other day and I asked them, do they have an interest in a family trust? And they said, I don't know, how do I tell? It was like, well, do your parents have a family trust? And they said, yeah. And they said, are you a beneficiary? And I've gone, yeah. I said, there you go, you just failed that test. So people may not realise they're actually going to be swept into it based on what we think is a pretty obtuse way of categorising non-residents.
Well, the good news is that it's not law yet, so hopefully they see the light of day, or these rules don't see the light of day. So we'll wait and see what comes out of that. But I guess that's the benefit of the submission process. If enough people raise the alarm about how concerning that may be, then they may listen. Although the squawking we did around main residence exemptions didn't seem to help too much. So I hold hope, but if there's tax on the line, you don't know if the government's coming to party or on that or not.
No, exactly right. And I think that's the bigger thing is can we get from 45 days up to 90? Then that provides a bit more breathing space.
Yeah, look, in my discussions with Treasury, it seems like 45 days is out the window. The question is whether or not it's 60 or 90. They in the early stages of negotiations, when I was part of that, they seemed to suggest that 90 days wasn't on the table, but 60 was. In the submission document, they did ask about whether certain days should be carved out of that day period, which I think there's good arguments for some of that being the case. But I also see the counter argument to that if you start carving this day and that day out, you end up with an administrative nightmare trying to track all these things. And does that really outweigh the benefit of having the odd person in or out? I'm not sure if it does. I prefer a more simplistic approach and probably a more generous day number personally, but we'll see what comes. So this is the flow chart that's provided in the rules. They talk about if you don't meet those initial tests, whether you're ceasing or commencing residency. So for people who are who don't meet the initial test, the question is whether they spend 45 days or more in Australia this year. So this is for a non-resident prior. If they haven't spent 45 days or more in Australia, then you wouldn't be a resident going forward. Simple as that. Move on. If you did, then you apply those factor tests. And that's where if you satisfied 2 or more of those tests, you would be a resident from the day that you arrived. If you didn't satisfy 2 of those, then you'd be non-resident. So 45 days, as we mentioned, is a pretty low threshold. So even if that was 60, that still could raise some alarms in my mind, but we'll wait and see. Maybe they'll change to a greater number of factors. I think we've covered off effectively how this might look.
Yep. Just push on the next one. So these are the questions that Treasury was asking.
These are the questions that came through the submission. So that what they asked was, is the 45 days reasonable? And should other circumstances count to carve out days? And we took the view that both of those answers should be that 45 days is too short, and it would be nice if certain days were excluded, but we did sort of mention at the same time that simplicity is the aim of the game with this. We don't want people to be debating whether or not taking on a weekend to a trip, which is for work purposes, then puts you in or not. It's probably digging into the minutiae that probably isn't beneficial to anybody. They asked whether or not those factors were the right factors to be applying, and we thought those factors were all quite relevant, but certain factors had more weighting than others. And part of our suggestion was whether or not there could be a points-based system on particular factors, and hitting a number of points meant that you actually satisfied that as opposed to others, because merely having a super fund in Australia or having a property that you rented out, I think doesn't have the same connection to you, say, running a business still out of Australia, right? So we raised a few other suggestions on the potential factors that might be applicable, but so we'll wait and see whether or not they are something that the ATO is interested in, well, the Treasury is interested in, sorry. Yeah, I think we've covered that off as well on commencing.
Yep.
So they also asked about the transitional rules, and I was pleased to see this question. It shows where their mind's at with this, that they don't want to leave people high and dry with these rules to just come in and all of a sudden people who have made plans based on a particular set of factors all of a sudden find that their situation is different. Something that happens to people I speak to every day, where if they are going to Saudi Arabia or UAE and they are having to pay Australian tax, it would be absolutely a deal breaker for them. They might have had an uplift based on what they're earning in Australia to make that move, but they're also moving their whole family, incurring a lot of costs, moving away from friends and family and what they're used to. So they want to be remunerated accordingly to make sure that it's worthwhile for them. As soon as you have to pay Australian tax, then it's a deal breaker for them. So it does sound good that they are interested in considering these transitional elements, and they asked for our thoughts on what that would mean. And our suggestion was that we would grandfather the current rules for a certain period of time, and suggested you could adopt into the new rules if you wanted to, but effectively you could choose the existing principles if it was more favourable to you as well.
So like some sort of anti-detriment clause or that sort of thing?
Yeah, exactly right. Exactly.
And I've just put up on here on the screen as well too, QR code. If you did want to read our submission, if you do suffer from insomnia and need help sleeping, if you're like Ben, where you're up in the middle of the night, feeding kids and stuff like that, then this will certainly put you to sleep. So maybe don't read this before you feed the kids. But yeah, if you want, this on our website, you can have a quick read and see what our points were, and I think they're quite valid at the end of the day.
Yeah, so I guess next steps from here is that, the Treasury has received a lot of submissions from what I understand. I tried to get Treasury to tell me how many. They haven't released it on their website yet how many they've received. So it'd be interesting when they do release all those. I've read a number of other people's submissions, and people have a lot of the similar thoughts that we've raised in ours. Nothing that seemed to just jump out as us being off the mark on where other people's thought processes are. So that's reassuring in some respects, that maybe the tax office and Treasury, who are working together quite closely on this, get some of these points across. But if we think about the way that the whole mechanism works, it's going to be 6 months that they rake through these at least. Then they've got to go send it to someone to draft up rules. They've got to model basic rules on what that means for their population to run tax numbers. Once they get that data back from modeling, they then need to actually draft the legislation and put that out as an exposure draft for comment. And then once that all gets the green light, it needs to go through the parliamentary process. Depending on how long that sits there, that might be a few more months. So I'm expecting by that to roll around. I wouldn't expect them to introduce anything at the start of until the start of a tax year. So if they brought it in August, it wouldn't be to the following tax year that would probably start, because otherwise you'd have two different tax systems. It doesn't make sense. So I think for it to be prior to the 2025 tax year, I think would be very optimistic, more likely to be 2026, unless there's some.
Oh, I think I just lost your audio there, Ben.
You still got me?
Yep, coming back now. There we go.
Yeah, great.
Yeah, no, look, I agree. I think, there's too much water to go under the bridge first before they can get this out. So for those thinking that this could come out, 1 July next year, it depends on how preloaded everything is in the background. If they're just paying us lip service and all the work you've said has already been done and they just push it through anyway, then, but even then, Parliament stops sitting on the 30th of November and it doesn't resume until February. So essentially, they've got 3 months to try and get it through the lower and upper house, assuming that all the other work you've said has been done.
Yeah,
So,
I can't see that happening, but yeah, you're
no,
right.
I totally agree. Yeah, so I think, 1 July 2025, plus is certainly the issue. And then in that exposure draft, are they talking about a 2-year implementation? Or has this process been the 2-year heads up? Or, there's a couple of things in the Border Taxations report.
Exactly, and I think the grandfathering might be the answer to that, which means that, for our expat community, that we probably don't need to worry so much about that, because you've probably got a 2-year period, a grace period, I would expect, to let people ease into these rules.
Yep. No, I think you're spot on, mate. Spot on. So, well, let's. So for those folks here who on the call who are not based in the UAE, now's the time to make a coffee. I'm just going to quickly run through. This is what I think is a big change here in the UAE with respect to how you manage your funds. So for those Abu Dhabi, Dubai, Fujairah, Ajman, Al Quaim, RAK, everyone would know the end of service benefits like an accrual basis. So based on your time of service, you might work for a company for 5 years. When you leave that company after 5 years, you'll then get paid out an accrued benefit that you've earned from that 5 years of service. Now what the UAE has been doing, and it started in 2020 with the DIFC, which is where we're based. Now they're rolling out to all the other Emirates, a new end of service benefits system, which those folks, as I'm talking through it, you got to recognise looks very similar to super. So what's going to essentially happen is 5.83% of your salary every month is going to be paid into an external account. So no different to super. In Australia, everyone's 10 or 11%. I keep losing track of where we're at now, but that money will be paid into a separate account, not held by the employer, but actually held by a trust. And you will then be able to select where that money's invested and how it's invested. No different to super fund, based on everyone's different style of risk appetite and so on. Where this gets complicated for expats, because this is good news. I mean, we all know those people who spent time in the sandpit have heard of many war stories of people leaving and then not getting paid out there in a service benefit because they've gone back to Australia, and what are you going to do from Australia to try and get a company in Dubai to pay? So to me, this is good news. Where it's going to require a lot more consideration is for those folks who listen to our podcast. James and I released an episode this week about the importance of timing. There's a obscure rule in Australian tax law called Section 99B. And those folks on the call who work for Emirates or Qatar Pacific will know what I'm talking about here. And essentially what that means is if you crystallise a gain in a foreign trust in the year of your residency, then that money is accessible from a tax point of view. Primarily not designed for expats, actually designed to tax Australian tax residents. But if you happen to be in the country as a tax resident in the same year that you crystallise that gain, then there is a good chance that the ATO is going to try and sting you capital gains tax on the accrual, so on the increase in value of that account, not the employer contributions, but the growth that that account experiences. Emirates crew well versed in navigating this, and they've heard me talk 1,000 times on it, but essentially now it's being exposed to the broader Australian community in the UAE. And what it's going to mean is, in a perfect world, you don't crystallise gains in the same financial year as your return to Australia. So let's say, for example, you're going to return to Australia in September, but you know about it in advance, then you will actually go to cash in that account pre-30 June, even though you're in Dubai or UAE, it doesn't matter. Because then when you return to Australia post 1 July in the next financial year, you haven't crystallised any gains. You're just pulling cash out of an account. So this is going to be an important one, because the last thing you're going to want is for any, actually I just realised I'm not even flicking through my slides, I'm just talking. So what we're going to, the biggest thing is you're not always going to know if you get a return. Most folks have an idea, And a usual scenario that we see all the time is going to be a move back to Australia pre-Christmas, and the kids start back at Australian schools come January after the 26th of January Australia Day. So if you know that 12 months out and you've been talking to schools and stuff, then you've got to want to consider what you do with these funds. Now, if you've been here for a year, we're not talking sheep stations, it's not going to be a big amount of money. But if you've been working here for 5 or 10 years, it can be quite significant. And probably the worst one we've seen was with a gentleman working for Emirates who had 18 years of Provident Fund saved up, and unbeknownst to him, returned to Australia, and he got a nice little tax bill from the ATO. Don't know how they found out. Honestly, still to this day, I wonder how they found out. But these days with the Common Reporting Standard, all these things going on, just assume that they know is what I say to all clients, and then hope that they don't. This was during COVID. I would have thought he would have got a bit more leniency because he lost his job, obviously, with the airlines shutting down. So, but unfortunately, I think he's still trying to fight that battle to this very day. So essentially what I'm saying is, if you are planning on returning to Australia and you do have a sizable end of service benefit, call it your Dubai or UAE super fund, just be mindful as you approach that 30th of June threshold that you may need to make some changes in that account if you are planning on returning to Australia post 1 July for that next financial year. So it's something that not a lot of folks are talking about. Actually, to be honest with you, we're the only ones who are talking about it. So it feels like we're sort of yelling into the wind, but just get that word around that, there's going to be a transition period. Right now, it's not compulsory, it's voluntary, but if once your company or your employer does put you on it, it is compulsory. So you can either be an end of service benefit or this new Provident scheme. But once you're in it, you're in it. So just be mindful of that if you are looking at a repatriation back to Australia. I'll just quickly blaze through these slides here, but we'll be sending out a copy of the slides as well too, to see have a read. But essentially, forewarned is forearmed. That's what the whole point of this this webinar is about. Just give you guys a heads up that it is starting to come through. I think 1 November was when it started for mainland UAE. So watch this space. Okay, so now we're just going to quickly go through and do a run through on some of the major markets, the property market, the share market, the currency market, and then at the end, Ben and I'll come through and talk about a few strategies. So on the property market, there are headwinds and there's tailwinds, and this is why we've got a market that is divided, I guess you could say. On the positives, you've got new migrants coming in, an extreme shortage of supply, which is why the prices are very firm. Next Tuesday, obviously, we've got the RBA meeting, odds-on chance of another rate rise given last week's inflation numbers. It is having an effect in terms of grinding things down, but to me, what is propping things up is that whole shortage of supply. There is, record low housing approvals in terms of, new properties being built. So that is keeping supply very short. However, on the other side, we are only really halfway through the mortgage reset. This is this mortgage cliff that everyone's been talking about. And I'll show you a slide in a second. Where property is not like equity markets or currency markets where the price is instantaneous. It does take a while to cycle through. When a bank, when the Reserve Bank raises rates, most of the time that doesn't flow through to the mortgage holder until 2 to 3 months after that actually event's occurred. So it is a slow-moving beast, and we're now starting to get to the sort of tail end of what's going on. If the RBA do raise rates next week, then that won't actually come into effect until January or February, depending on which bank you're with in 2024. So it is death by 1,000 cuts. The big question is how many more rate rises are there to go? We originally thought that this was going to be the last one. For those who listen to the podcast, we've been talking about this quite a fair bit. Given the fact that we've got oil prices going up and still got record low unemployment, this may open the door to further rate rises. Michelle, who's the new RBA governor, was very vocal the other day saying that we will not be a slave to inflation and they will do what they have to do to get inflation down. So read between the tea leaves. If she thinks they're going to have to take the hard hit early, she will. So just keep that in your back of your mind, that certainly odds on for a rate rise next month. Next week. And then the next one as well too is all these houses Canberra's going to build. So essentially 1.2 million new houses in the next 5 years. Obviously, that's going to dramatically have a big effect on supply. The question is, can they actually do it? And in terms of the physicality of it. So to give you an idea, they've actually got to build a new Canberra in terms of the scale of it. So it is very, very large when it comes to, Canberra every year, I should say. So very, very large when it comes to the scale of what's going on. Will we have, the skills, the people employment to be able to build 1.2 million new homes? Can they find the bricks, the suppliers, all that sort of stuff, all these pain points that the market's experienced over the last 12 months. So as you can see, there's a tug of war going on there between the two. What we're concerned about right now is Australia is on that sort of, I wouldn't say a thin ice, but it's a thinning ice when it comes to people's capacity. On one side, you've got full employment, people can walk to another job if they wanted. We are starting to see that start to change. So when we look at financial stress, essentially financial stress is when you are unable to, after you pay your bills, you're not able to have any free cash flow or service those debts. So as you can see here, it is picking up, and that's something we're watching very carefully. People are still having their $20 lattes and smashed avocado and toast, but the noise has certainly increased, that's for sure. This next chart over here on the right-hand side, the CBA. So this is CBA's fixed rate home loans rolling out. So as you can see here, the bulk of those are actually occurring right now in December 2023. So this is probably the worst of it right now. The question is how people, going to be over the next 6 months, with obviously rolling from a low fixed to a higher variable loan. And then this continues actually out to June 2025, when it's about 12% of their mortgage book. So there's still more to go, but the bulk of it is actually happening right now. So to me, first, second quarter of 2024 is going to give us a real insight into what's going on there. Onto the share market. So certainly, as there's investors and there's economists. We're investors. So we obviously look for opportunities. Even when markets rise and fall, they don't always rise and fall at the same time. So what we are starting to see are opportunities. Healthcare stocks are looking probably the cheapest they've been for a long, long time. So when we always look at it, there's not an equal distribution between winners and losers. You need to actually sort the wheat from the chaff when we go through these sort of scenarios. When we looked at portfolios for our clients, going back to April last year, the first thing we did was what sectors and companies thrive and survive in a high inflation, high interest rate environment. So 9 times out of 10, that'll be things like energy stocks, IT stocks, healthcare stocks. What do poorly? Property stocks, consumer discretionary stocks. So go through and look at those sort of scenarios, because when we do get scenarios like we've been in over the last 3 months, the baby can get thrown out with the bathwater when it comes to good stocks being sold off for no reason. So there are certainly a lot of opportunities out there right now. Bond yields, to me, this is a relative term, and clients who never knew what a bond yield was before are now quoting me chapter and verse how bond yields work. Biggest thing for us, essentially, bond yields aren't high. They're just higher than when they were a couple of years ago. So if we can sit there in the chart, we're certainly back to where we were back in, say, 2010. But as we go back to the 1980s, you can see bond yields were way higher. What we look at in the bond market is essentially supply and demand. Now, people don't realize that you can actually lose money in bonds because you're essentially buying an asset at a fixed price. And if you pay too much for that bond and it gets redeemed, yes, you'll get some sort of blending effect in the yield to maturity, but you still actually have a capital loss because they always redeemed at par issue price of $100 a share. So certainly for us, we're expecting the market to trade in a narrow band from an ASX point of view, 6,800 to 7,200. Obviously watching what's happening in Israel very closely. The big question is will any other state actors partake, or will this be sort of quarantined and retained to Palestine and Israel? So at a humanitarian level, we're seeing is absolutely disgusting, but I won't go into that. But certainly from an economic point of view, if it is contained, then I don't think we will see any sort of economic ramifications. If it does extend to the greater part of the Middle East, then that's the big question. If we look at where I'm based in Dubai, our friends in Iran are only 120 miles that way. We've got the Strait of Hormuz, where all the boats that leave Saudi Arabia and Kuwait and Qatar go through to get out into the Indian Ocean. 1/5 of the world's oil supply goes through that very narrow strait. So if Iran do decide to, be a bit crazy and have a crack at everyone else and try and shut down that, then we will see a dramatic effect. We will see oil prices go through the roof, and then we've got bigger economic problems at that point. But do I think we've got to get there? No, I don't think Iran has the capacity to fight, the war on the Western Front, and I think they'd rather use their proxies to try and achieve their goals rather than go into an all-out war. So, as I say, the turning point is likely if bad economic news forces central banks to start cutting rates. That would be if Iran does something, then you would see the central banks change their tunes very quickly, because the last thing they want to do is stall the economies. So winners and losers, as I said before, technology as an example, just 10 stocks, which account for 30% of the US large cap market, make up nearly all of the year-to-date returns for the end of the second quarter this year. So, just go through and look at things. Financials, Australian banks right now, record low net interest margins. So they're certainly not killing it. They have been killing it for the last 5 years, believe it or not, and even 3 years before COVID. US banks, obviously a number of regional US banks were dissolved and they got taken over by the government. Real estate, primarily commercial, primarily office. There's a big struggle with employers trying to get people back to work. So just keep an eye on that side of it, because we are seeing KPIs now for workplace attendance and stuff, but whether the employers can convince people to get back in the office, will really dictate whether those markets are any good or not. So onto the currency, just running through here, Australian dollar, as you can see, for those folks who earn anything but Australian dollars, it's not a bad time at the moment. So up and down, certainly with the US Fed this week deciding not to raise rates and a high chance of the RBA raising rates on Tuesday, we have seen the Australian dollar firm up to 64 cents this morning. Do I see it changing much more than that? No. And the reason being is I don't think Australia's going to really try and price themselves out of the market in terms of the interest differential between US and Australia. Two things drive the Australian currency: interest rates and commodity prices. If we do see more engine misfiring going on in China, then certainly commodity prices will continue to fall, and then that will certainly bring the Australian dollar back as well too. So if commodity prices fall and interest rates don't change, then you'll see the dollar around 61, 62 over the longer term. If we see Australia raise rates, the US not, then maybe 64, maybe 65 at a push. If we see commodity prices rise and interest rate rise, then we're going to probably be back up into the 70s before too long. Onto the euro, talk to clients in Europe. Back in July, August, they're killing it. And then what we're seeing right now is a rotation back to sort of the mother currency, which is the US dollar. When we get economic uncertainty or world events, geopolitical events like we've got right now, people do hide in the US dollar. So right now, the race is on with respect to what's going on in Europe in terms of more rate rises. Germany seems to be main sticking point with Europe in terms of their economy and what they're doing there right now. So do we think there's more to go with Europe? We do. 3.25% right now. More to come when you look at, say, Australia at 4.1. There is a differential there as well too, and the ECB would definitely be aware of that as well. Same with the pound, as you can see, almost identical chart with the euro. Bank of England really struggling to make these choices right now. You've got an economy that is starting to misfire a bit, especially in the property sector, and people are trying to work out, okay, when do they say enough is enough? Obviously, with their rates a lot higher, we can't see it getting too much more. But then again, I think what's happening in Israel with what's causing the oil price is enough of an effect to probably tap the brakes anyway. And I think a lot of central banks will be relying upon the rising oil price in order to just sort of slow things down. Right, guys, well, let's run through a couple of quick strategies that you can execute straight away to give you as much value. And Ben and I will sort of talk you through these ones here. So Ben, I'll take the first one if you want, mate. So a lot of folks ask us, I have money sitting offshore in an investment account. Isn't that better than Australia? And the answer is yes and no. So the answer is yes, if you want probably a widest product suite in terms of choices. But if it is a US domiciled account or US situ, as they like to call it, then you do have two key issues or two problems you got to address. First one is non-resident withholding tax. Like in Australia, the IRS charged 30%. Unlike Australia, we can use franking credits to offset the non-resident withholding tax. In the US, they do not have any franking credits to do that. So essentially, you'll lose a percentage of that non-resident withholding tax. If it is back to a country that has a DTA, it can reduce it down to 15% in some circumstances. The other one too is estate planning tax. A lot of people don't realise this. So if your account is US domiciled or you're holding US domiciled assets, and let's say it's a joint account, husband and wife, husband passes away, then what will happen is your account will essentially be frozen while they do a review, and they'll work out whether any US estate planning tax is eligible to be paid. You could never set foot in America and never have a plan to set foot in the United States, but because your account is domiciled in the US, it is subject to US estate planning tax at 40%. We have seen a wide range of different opinions, both from the platforms. When we thought platforms weren't US domiciled, they've confirmed they are, and vice versa. So, don't be the person that finds this out by experience. Make sure you do go and look and see if your account is US domiciled. As an example, if you hold an interactive brokers account, which is probably the most popular one, email their estate planning team, and they'll actually confirm to you whether or not you're exposed to US estate planning tax. All right, Ben, I'm going to hand this one over to you, mate. So if you're contributing to super, what's the options and where's the pitfalls?
Yeah, of course. Look, obviously when you're in Australia, you're contributing to super through your employment, but that doesn't happen when you're outside of Australia. But if you are planning to retire back in Australia, then every good financial plan should involve some sort of strategy to get some money into super, because the concessions, once you move to pension phase, are undisputed in how concessional they are. So a lot of people will take up the idea of contributing to super whilst they're overseas still, but you do sort of need to understand how super works. There's two different types of contributions you can make, either concessional contributions or non-concessional contributions. The short difference between the two of them is the concessional contributions give you a deduction in your tax return. The non-concessional contributions don't, but the concessional contributions get taxed at 15% when you put the money in. So, and there's different caps available that you can put in each year and different catch-ups you can do, but broadly you can put a lot more non-concessional in, 110,000 a year or 330,000 if you want to put 3 years in at once. Non-concessional, you can put in 27,500 a year, and if you haven't used up to 5 years previous caps, you can use those as well. So that's sort of quick and dirty on the contributions caps. Whenever you contribute to super, it starts off as a non-concessional contribution until you submit a form that says, I want to claim a deduction for this in my tax return, the Section 290 form, and you nominate how much of the contribution you've made as being eligible for a deduction. And that's good because you can actually do your tax return and figure out how much of that you want to include it as your tax deduction. What you can't do is use it to generate a tax loss. So where it doesn't help you is if you're making a concessional contribution and you don't have any taxable income in Australia, because then you've effectively got 15% tax in the fund and no tax benefit on that contribution at all. So that's a very tax inefficient way of doing things. It's much better to just treat it as a non-concessional contribution. Where you need to be aware of is people think, oh, I've got investments and maybe I don't, or maybe I've got taxable income. If that income is just subject to withholding tax, that is not something that you can claim a deduction to offset that against. So that's typically where you've got managed fund components that are interest, unfranked dividends, those sorts of shares would not be taxed as ordinary income. It's really rental properties and other income that's based in Australia would be, or like capital gains, for example, would be able to be reduced as a tax deduction. So you really do need to understand your income mix to see whether or not a concessional or non-concessional contribution is beneficial to you. Where we typically see it most beneficial is where you've got a positively geared rental property. So a lot of people like to keep their properties kind of neutrally geared, and that can be managed through an offset account if you've got the ability to take funds out or put funds into that to keep it kind of neutral. Because if you have a negatively geared property, then it means that you're putting funds out there that you're not receiving a tax benefit until much later down the line when you roll forward those losses and then use them at a later point. If you're okay with that, no problems. But a lot of people don't like that idea, and so if that, and I've also seen a lot of people who have positively geared properties because they've lived in these homes all their life, they've paid down their loans, or they've got low balances and that was their principal place, so they're quite positive. A strategy is to contribute to super and treat it as a concessional contribution, which effectively means that you are then getting a tax deduction for the amount you contribute to your super, up to the 27.5 cap per year overall. So that's can be quite effective. There's a few sort of words of warning on that particular aspect. If you're in a non-taxing country like Saudi or UAE, then absolutely that works really well. You need to be a little bit wary of the countries where they also tax you on your rental property, because I've seen many scenarios where, you know, say you're in the US and they would tax you on your rental property income. If you completely eliminate your tax bill by contributing to super and claiming a concessional contribution in Australia, then that's all great from the Australian side. But then when it comes to doing a US tax, what they would typically do is allow a credit for any Australian tax that's been paid in Australia, because it's an Australian sourced asset. So they, under the double tax agreement, need to allow credit for Australian tax paid. But if you've eliminated that, then you've got no credit to play with, and then you're paying full tote tax in the US. So if you add that to the 15% tax that goes into your super fund on top, you're actually in a much worse situation than if you hadn't contributed anything to super and claimed deduction and just paid Australian tax, which may have completely eliminated the US tax or meant that there's just a small amount of tax to pay. So it is something that you do need to understand in context of your circumstances. And if you are looking for particular guidance, we can help you through with that.
I suppose call it, mate, it's like a two-dimensional vice, isn't it? You got to sort of tap your head and rub your stomach at the same time, because, you know, certainly places like UAE, no concerns, but when you are in a more regulated market like Europe, UK, United States, you know, we actually had a case where it was actually a question put up on our Facebook group, and this person had accrued losses, and they were going to be selling an asset this financial year, but by selling the asset, they are going to have to use the accrued losses to offset it, but they still had to pay tax in France. So he wanted to know whether they could choose to ignore the losses and actually pay tax. But unfortunately, as you know, if you've got a loss sitting there, it's the first thing that comes off the top, isn't it?
Yeah, exactly right. And look, there is a process with all the way that the ATO applies these particular things. So when you're selling a property, the first step is to use up unused capital losses, and then they apply the capital gains tax discount to what's left. So effectively, you're losing the benefit of a discount for that portion of those capital losses. And then, so there's certain strategies regarding on how that's best worked, but it's also why a depreciation schedule is often a great idea if you can claim building deductions, because that comes off as a revenue deduction and means that you're getting the benefit of that every year to either generate a loss or bring your taxable income down. But when you go to sell the property, if you're able to carve some of it out through main residence exemption, if you do sell whilst resident, which is what we advise most people consider doing rather than selling whilst non-resident, and then also the CGT discount percentage, which is available to them to the extent that it is available then that reduces the overall taxable amount, which means that you've claimed the depreciation deduction at full amount, and even with the add back that goes onto that, you're getting a much better outcome by doing it that way.
It comes back to my comment before about timing, isn't it? Timing's
Yeah,
everything when
exactly.
you're managing money. It's a day here or a day there can make the difference of thousands, tens of thousands, and sometimes hundreds of thousands.
Yeah, 100%. And look, there's ways that countries get around certain things as well that I've seen. For example, I had a client in Germany who sold their property after that voluntarily left Germany, but it was in the same tax year that they'd sold their property, and Germany wanted to consider their worldwide tax outside of that, not for the purposes of charging tax on their Australian income, but for the percentage of tax that they were charging on the German income. So it's a cute way of getting around it not actually being subject to tax, that property sale, but it put them effectively into the highest marginal tax bracket in Germany and meant that all their German-based income was actually taxed at a much higher rate. So you do need to be very aware of not just the Australian impacts, but overseas impacts as well.
Definitely, mate. Well, I think let's run through some of the questions that have been coming in thick and fast. Guys, while we're running through this, QR code up on the screen. Feedback we're driven by it. Obviously, there's no price of admission when it comes to these webinars, and all we ask is your feedback and responses. So if you could jump on there, it won't take more than 1-2 minutes. So your feedback would be greatly appreciated. Let's run through a couple of questions here. So first question from Richard. What about a CGT event, e.g. a sale of a property in Dubai as a non-resident before repatriating back to Oz in the same financial year? Will that be taxed?
The short answer is it depends on the particular property. Are we talking about an Australian-based property or a overseas property?
I'd say you're selling a property in Dubai, and then in the same financial year, moving back to become a resident of Australia, tax resident of Australia.
So typically, I would assume that the property was acquired whilst you're a non-resident and then sold whilst non-resident, which means that if it's not taxable Australian property, which it wouldn't be if it was a Dubai-based residence, then it shouldn't be subject to any Australian tax if that was all sold prior to coming back to Australia. If you did come back to Australia and you held that and you waited, then you do get deemed acquisition as the market value on the day you came back. To say it's worth $1 million on the day you come in, despite the fact you only paid $500,000 for it. Then if you sold it for $1.5 million, then you're only taxed on the 5 gain since you came back.
Since you came back, good advice. Next question from Neil. I'm 48, married, living in a home I own in Australia. Runs 2 businesses there and has 2 family trusts. We're planning to move to the US, then the UK, where we have retirement assets we can access in 10 plus years, then move back to Australia in 20. But it sounds like it will be impossible to shed residency. Sorry, I just lost the spot of the screen here. Lots of questions coming in. So
I think he's referring to the new rules based on that. So look, the under the new proposed rules, which are still not finalised, to reiterate that point. So I don't want you to make absolute assumptions on that yet. But even under the proposed rules, if you were outside of Australia for 3 years and not in Australia for 45 days in any of those years, you would become non-resident at that point. Or secondarily, if you obtained employment overseas with a 2-year plus contract and didn't come back to Australia for 45 days in that time, then you would also become non-resident from the time that you departed. So there is pathways to becoming non-resident still, but based on what it seems like that asset mix, there would be ongoing Australian obligations that you need to consider for a lot of those assets.
I guess what we don't know the answer to either yet is the tiebreaker provisions in the DTAs. So in this case here, he was going to the US, then the UK. Both those countries have DTAs. So technically, even if he did breach the rules from the Australian point of view, would the tiebreaker provisions come in and protect him on that side?
Yeah, and look, that's a very important point, because what people don't, I think, have a good concept of is how the double tax agreement works over the top of the legislation. So first instance, you're looking at the Australian legislation to work out your residency. US is doing the same if you're moving to the US, and then over the top, if you are a resident of both countries, the double tax agreement between Australia and the US will say, based on these criteria, you are one or the other. You can't be both. But that's only for the purposes of reading that double tax agreement. You still complete your tax return in Australia as resident, you still complete your US tax return as a resident there, but the way that the residency works under the double tax agreement dictates for all these different asset classes and income classes how that income is taxed, who gets to tax it first, who potentially is not allowed to tax it at all, and who needs to allow credit from one country to the other. So you need to really follow each of those things carefully. But a small rule of thumb is that if the income is earned in a particular location, you would assume they get to tax you on that first. The other country would need to allow credit, or they may not be able to tax you at all. So for example, Australian-based property, you would assume Australia gets first taxing rights. If it's employment income earned in the US, then they would have first taxing rights on that. So you do need to work through the scenarios quite specifically. The first tiebreaker clause in just about every double tax agreement is where you've got a permanent home available to you. So you'll normally automatically default to where you've got a lease or a home available. So in most 99% of the expat cases that I would talk to, people don't keep a home available to them in Australia when they go overseas. So they would typically default to tie broken in the other country, which often gives almost a better outcome than being a non-resident in certain aspects, because you still get the legacy main residence exemption, CGT discount applicability, although carving out a whole bunch of income or having it not subject to Australian tax at the same rate if you're just paying some top-up tax. So it's not all doom and gloom with some of these particular aspects.
Especially down to places like the US and UK, because the tax rates are not too dissimilar to Australia anyway. So going to the Middle East, different story. So
exactly right.
Being mindful of the time, we'll get through these. So we've covered on that one. Okay, question from Sunny. How does the proposed tax residency changes affect expats who left Australia in the past 1 to 2 years? Or how does it affect expats who left before the rule comes in?
Yeah, so this goes back to, and maybe you weren't on the call at this point in time, but there is a suggestion that there's going to be a grandfathering of the old rules for a period of time. So our expectation is that you should be okay. There should be a number of years for you to assess the situation. Now, obviously, probably after a 2-year period after they bring it in, you probably then need to reassess where you sit, but it does give you some time to plan that, when we are at the moment still probably at least 18 months from implementation.
Yep, no, good answer. Our next question from Paul. Would an Australian superannuation policy be considered as a bank account with Australian bank with significant cash deposits? I guess referring onto that factor test under the economic assets. So yeah, I'll let you answer that one.
I don't know. That was considered owned by a different legal entity. Super fund is not a local asset, but at the same time, anyone who's got a rental, I don't know many people who wouldn't have an Australian bank account. But I guess the second part is, what's a significant deposit? It's got to be quite a sizable number. I'm assuming it's probably in the same realm as what they would use for the TOFA considerations, which is 250 grand.
$250,000. Yep.
So, but remains to be seen. But I don't think the superannuation balance would be applicable there.
Yep. No, I totally agree, mate. Totally agree. Here we go for a question from Honey. I want to run past the strategy for expat regarding surplus cash which you repatriate to Australia. I believe you lose the tax deduction if you put money into an offset account in Australia, and could result in taxable income taxed at non-resident rate, and hence a better strategy will be to put it into an alternative area. What are some of the suggestions to put the surplus cash which would at least return the current interest rate on mortgages, and before returning one could cash in and settle the loan before resulting? I'll handle that one, mate, if you want. Essentially, there are no guarantees apart from cash rates. So if you're open to volatility, depending on your time frame, you might put it into shares. Domiciled shares in Australia treated as what we call non-taxable. So you can actually, for the first time in most people's careers, they actually have a tax rate in Australia working in their favour. And essentially what it means is you can buy a share at $1, it can go to $2 while you're away. When you move back to Australia, you're deemed to have acquired that share at whatever the price is on that day of return. And then any growth that you've experienced in the prior period is not taxed by the ATO. Now, catch is not guaranteed return, unlike a cash account. B, whether it's a return greater than mortgages or not, it's who knows. I mean, the last couple of years have been rather volatile, but if you're taking a long-term view, 3 to 5 year view, that could be an option for you as well. So on to the next one here from Tibor. Tax residence certificate. Should I get a tax residence certificate from the UAE? I'll just explain to Ben here. So they've recently introduced these TRCs here in the UAE. It's always been here, but they're now a bit more solid now that we've got corporate tax coming in and the concept of tax residency is becoming an issue. I guess layman's question, does the ATO need to see a tax residency certificate for an Australian living in the UAE?
It's not essential. It's a self-assessment system. The tax office will look at a number of other flags to see whether they would inquire as to whether or not your tax return is completed correctly. I've not seen them ask for one in the past. It's possible they might get there. At this stage, I think they're more likely to look at what you've put on the return, what your flights in and out of Australia look like, and that's probably the first flag for them. If you're under sort of 2 years, they might then start asking questions and say, well, let's have a look a bit deeper. Even if you were a resident in UAE, it doesn't mean you're not a resident in Australia too. Because there's no double tax agreement between the two of us, it doesn't save you from any of the protections that you'd get in a DTA tiebreaker situation.
Yep, good answer, mate. Another one here from Peter. I'm a non-resident for tax purposes residing in Panama. Will get a sizable inheritance. Is that taxable? So I'm assuming he means from an Australian point of view.
Short answer to that is inheritance typically isn't taxable when you receive it. If it's being cashed out and you receive cash, then you're fine. If you receive assets like shares, etc., then you inherit the cost base typically of the person who gave it to you, subject to particular rules. But effectively, that means if you then go sell that, dispose of that asset, that's the taxing point that would need to be considered, and the tax rate is dependent on the cost base that you've got for that particular asset.
And it depends on, its property, are there main resident exemptions, in the 2-year rule, if it's shares, K3 events. I mean, you and I could talk for the next 45 minutes just on that one question. So I guess to give Peter his answer, yes, but no, but maybe. It depends on so many different scenarios there, because it depends on what the asset is, how long you've had it, and yeah, but certainly.
But the mere receipt of an inheritance wouldn't be typically taxable in Australia.
Yeah, like I said to clients, capital gains tax is inheritance tax by stealth.
True.
I think it's the best way to describe
it. It's how it works, yeah.
Yeah. Okay, on to the next question from Joel. I like this one. Most of what seems to be talking about being based on the assumption someone wants to be counted as a non-resident for tax purposes, but he wants to remain an Australian tax resident if possible. So I won't go into the whole thing there, we probably haven't enough time, but we see this quite often, certainly those who have government pensions as well too, because they don't want to be taxed 32.5% on the first dollar. So can you be live overseas and be a tax resident in Australia?
Only if the facts support it. It's a self-assessment system, but I wouldn't just flag yourself as a resident. There was a time where doing that would almost never raise the eyebrows of the tax office, and they would sort of just accept it because there wouldn't be scenarios where you'd be beneficial typically by being a resident. But we're seeing that now, particularly with some of the things you mentioned, Brett, but also the main residence exemption and the CGT discount rule changes. And even people with self-managed super funds, which risk becoming non-compliant with non-resident directors, etc. So we're seeing this more and more. I see it as a positive in some respects, because then it keeps the ATO more honest in relation to how they do their residency rulings that set precedents for other people. You would need the facts to support residency, and you'd need to look at all those particular things to see where you could create a scenario that you would fall within that test. One of the 4 tests. The easiest is probably to spend more time based in Australia, but unless you did plan in some respects make Australia your home, then there is a risk there that the ATO could impart a different view to you submitting as a resident.
Well, they call rubber stamping, don't they? When you're just doing something to avoid tax as opposed to being a true intent.
Exactly right. Yeah, it's good. It's now has some risk on it if you submit resident when your facts don't support it.
Another question from Peter here. If I go back to Australia to visit the Australian office as part of my employment, does that count as days in Australia? So it comes back to that point of that day count, how we said, is there going to be exclusion for work travel or visiting sick family members or those sort of things?
Yeah, we suggested that should carve that out if it's work travel that you didn't really have control over. So that was part of our submission. At the way it's drafted, it wasn't contemplated. It was just a flat 45 days, which is part of the reason why just about every submission I've read seems to suggest that's a silly outcome.
Yeah, I mean, think of airline pilots, whether it's Cathay or Emirates, it doesn't matter what it is, they'll be in there every once or twice a month. They will blow through the 45 days very, very quickly. So exactly. Question here from Greg, what should you do if you inherit Australian shares from a relative while a non-resident? If you sell them, are you liable for CGT? Very good question. And I'll let you answer, but before I let you answer, I'll also recommend Greg to jump on our website, do a search on our blog just type in K3 event. But Ben, do you want to run through that one?
Yeah, look, it's an interesting one. Yeah, look, the effect of that is there is some Australian tax associated with that. You do need to work through the rules in K3. It's not a straightforward consideration. So yeah, I would. Yeah, the short answer though is yes, it's subject to Australian tax.
Yep. Okay. Another question from Adolfo. I understand that AU investment platforms, CommSec, Vanguard, etc., don't allow non-residents for tax purposes to invest in Oz. What options are available for Aussies moving to KSA who want to continue to invest in ETFs Australian domiciled? Is there an AU alternative to interactive brokers? And I'll quickly answer this one if you want. Look, the long and short of it is there hasn't been any change in legislation. There's been a change in appetite by platform providers dealing with compliance. If you think about like a CommSec, they're a low margin business. They rely on the fact that they don't know you from a bar of soap. They don't know any of your details. All they're doing is processing trades. The problem with that is you could be Fatima sitting in Kabul laundering money from the Taliban for all they know. So what they've done is essentially said, for by and large, expats are off limits. They'll freeze your account, and if you don't remove the account within a certain time frame, they'll close it and flick it off to an issue a sponsored account. The problem is all the other platforms are the same now. So ANZ, CMC, the whole shebang. Vanguard announced last month that they're going to be ruling out non-residents for their platforms as well too. So pretty much, unless we're being led to believe otherwise, the only real option folks have got is what we call an advised account. An advised account means there's an actually advisor attaching to it. Problem is, you've obviously got more cost than say a discount, but that advisor has KYC, which is know your client rules, AML, CTF, all these sort of things. That means that they go through and vet you who you are and making sure you're legit. So long story short, AU domicile, pretty much advised accounts are the only way to go now. That's not necessarily a bad thing. I mean, when we do see market volatility, 9 times out of 10, I can't remember the exact percentages, but advisors actually save clients quite a bit of money from panicking and talking through scenarios and provide a bit of context and perspective on the situation. So yeah, unfortunately, Adolfo, there's no real options available. Next question here from Peter. If I'm a non-resident for tax, can my wife still be a tax resident? i.e., are we treated as individuals or assessed independently?
You can be treated as individuals, definitely, or you are treated as individuals. It looks at the facts applicable to each of you. Often, if someone remains a resident, if your spouse remains a resident, that will indicate a strong connection to Australia still, assuming they have that strong connection to Australia, but it doesn't mean you can't have different situations, and the timing will also be different. For example, very common situation is people take off to Saudi. One working partner is going over there. You have to wait till you get the is it the ICAMA or something visa?
Yep, ICAMA, and then you can sponsor.
That takes like 90 days or so. The kids are still going to school, wrapping up the family home. It might take 6 months to get over there for the other spouse. In that situation, my view is that the first person ceases residency from the start date that they first left with the intention to make that a permanent move, and the other person becomes a resident at that later point in time once they bring the rest of the family. So that's a very common situation.
Yeah, no, I don't think I've ever met anyone who's actually become non-residents at the same time. I know my wife and I
Sometimes
left
the
in May,
stars
she left in
align.
August. Yeah.
Yeah, maybe
I think she
not
was smart.
maybe not in Saudi Arabia, but in other countries where you can get the visas together, at the same time, I think that works better.
What about the scenario like we're seeing quite often at the moment? A lot of folks going to NEOM. NEOM's got a shortage of accommodation, especially family accommodation. How long can you stretch that out in terms of one being a tax resident, non-resident, before the non-resident based on domicile and resides is considered a tax resident because the partner hasn't joined?
Yeah, it's a good question. That's a big question mark I've got over all the people I'm advising in that situation. I'm waiting for a private ruling to come up where I can say this is the tax officer's view on that, because my view is that you have the intention to move over permanently. For all intents and purposes, the family will join at some point, but there's no schools in that area. You can't do that. So the idea of setting them up nearby in UAE may not be very palatable if you're working long hours on this project. So my view is that then you still become non-resident. There is a good explanation as to why the family hasn't joined you. So whilst that is still a connection to Australia, it's probably less so than if it was a country that is well accepted that you would have the family move with you, and that's got all the facilities and trappings of home. If that's simply not available to you, I think you've got a good argument to suggest that that doesn't impact your permanency and desire to be creating a new home outside of Australia.
Definitely, and I think that's a very succinct answer. The answer is don't know, and that's the hardest thing, isn't it? I mean, I think what I've been telling all my clients to do, build a compendium of documentation just to show that if you ever get tapped on the shoulder, you say, look, the intention was there, just the mechanisms haven't come into play yet. And I think if I think back to the Harding case, that's what saved him, wasn't it? Because he could show intent. He had the cars, he had the kids at the school places. They never joined him, but the intent was there at the end of the day. So your actions speak louder than words.
Yeah, absolutely. And that's part of what we do, is to sort of document people's intent from the outset, because you think about it, you sometimes don't have a lot of documentation about what your intention was, but that's a big part of what the tax office will look at. So they'll look at things like, what did you mark on your departure cards? Whereas really that's the amount of people that have just marked it because they didn't understand what they were actually marking. For the AT to rely on that and courts to rely on it, they say, well, we don't have actually much else to go on. So, flagging with your banks that you're non-resident, those sorts of things, it's much easier to sit down with someone like myself and actually run through all the rules and say, we're documenting this. This is a piece of information that you can then show to the tax office at a later point as to where your mind was at this point in time.
Exactly. Mate, good response. Just before I answer the last question as well, too, for those folks out there who do want to have a chat to Ben, obviously just finished tax returns. I've never met so many expats out there in recent memory that haven't done a lot of tax returns. So even though 31 October has now gone past, if you do engage Ben, your extension actually goes out till March next year. So it makes a lot of sense. You can jump on, I'll put it up on the screen there, our website, atlaswealth.com. Certainly if you need help on the ground here in the UAE or Middle East region, or even Europe or Africa as well, which are the other areas we cover on the financial planning side, asset management side, let us know. We're always happy to help. Just running through the last question here from Alicia. What about reverse scenario when one partner and kids move back after many years of non-residency for senior schooling and the other partner stays in the UAE? Can the remaining spouse stay non-resident given the family has gone home? Are they considered separately?
Yeah, again, they're considered separately, and I would suggest that if the remaining spouse hasn't changed really the way they've, lived their life, then their situation continues as normal. Things that I would consider as being an issue is if you then couple that with a lot of time spent back in Australia, and obviously there's the lure of visiting your family. It's much better if the family can come visit you, but if you sort of go over a certain number of days, and my rule of thumb isn't legal position at all, but 45 days is where I feel is still relatively comfortable in a year. So if that sort of is breached, then maybe there is a change to your residency situation. But if all other things remain the same, maybe you just downsize to a smaller apartment, that's probably still okay. But if you then effectively are packing up your life and saying, well, no, actually I'm very different, and I'm actually living more in Australia than I am in the other country, then I think that's when your circumstances change and you become resident.
Mate, awesome answer to end it on. We could deal with a lot of those cases, especially folks come out of the UAE. So, Alicia, I hope Ben gave a pretty good response there. But I think we wrap it up there. I think we've monopolised people's time. It's almost an hour and a half now. So, folks, just want to say a big thank you to everyone out there for joining us today. Certainly to those who have completed the feedback on the seminar. Thank you very much. If you haven't, don't forget, we're still going to be sending out a copy of the slides to folks. For those who are watching this who couldn't join the call, feel free to reach out to us. And James and Jeremy will be the next webinar coming out later this month, talking about Australian mortgages and tax. So, and I think we leave the good folks there for the afternoon and the evening, and we'll talk to you later on.
Sounds great. Thanks, everybody.
Thanks, guys. Take care.